training is on how to calculate VA residual income. This is very important because if you do not do this correctly, you may not get an accurate AUS finding on a VA loan. I would love to do maybe some more training on other income issues, but since we're starting a little bit late, I think we'll just probably cover this today. But that is a beautiful PowerPoint. Kayla, did you have artificial intelligence create that?
Yes, of course I did.
Wow, that's pretty.
Wait, actually?
No, it comes from the PowerPoint
one in the system.
It's very good looking. All right. So all right, go ahead, Kayla.
Okay, so this is VA residual income. So there's a lot of information in this PowerPoint because it's going through a lot of different screens, or one screen, but it's all split up. So just most of your questions are going to be answered throughout the screens if it's not on the specific screen that we're looking on. So just bear with me to get through it all because it's just a lot of information, and then I'll answer all the questions at the end, I promise. Okay, so let's see. So VA loans require residual income calculation using the loan analysis form in Encompass. With a high DTI, your approval could depend on this calculation, and the calculation should be completed at pre-approval stage so we make sure that we don't have any issues moving forward. Okay, so I didn't put the section A and B on here because it's auto-populated for you. It's like borrower name and things like that. We're going to start with section C. Section C is also auto-populated for you, okay? But you want to make sure that they are the correct amounts, obviously, before we, move forward.
I'm sorry, can you explain where this is in Encompass? Did I miss that part?
Yeah, it's the loan analysis form in Encompass. So it's this form in Encompass.
I see. Gotcha.
Yeah. All right.
Good question though, Ryan.
The main part on this section is this maintenance fee. So the maintenance fee is this calculation, square footage of home times 0.14, and then you input it right there. Okay. I know at pre-approval stage, we don't usually know what the square footage of the home is. So just depending on the price of the home, I guess, I usually use like 2,000 to 2,500 square feet just to give it a basis. So you put that on line 19. All these other ones are going to be populated for you. Line 20 is your HOA fee. Just double check that they came in correctly. Okay. Section D is for your debts and obligations. This is going to be a little confusing, so just bear with me while I try and go through it, okay? Your debts from your verification of liabilities will automatically be put into the screen, okay? Now, it doesn't automatically get checked. You have to check the boxes in which ones that you're adding into your residual income calculation, okay? So if you have one that's excluded, you're not going to check it. If you're paying something off, you're not going to check it, okay? You will need to add the alimony support, child support, and the negative rents manually, okay? Job-related expenses would be childcare, commuting costs, anything at union dues, anything additional that is marked on the disclosure we send out. There's a specific disclosure that's sent out.
What would negative rents be? Would that be like if they have a rental property that's losing money?
Yes. So
okay.
yeah. Okay, so where it gets a little confusing. If there is more than 7 debts listed on your verification of liabilities, it is going to populate in other liabilities, and it's going to be the accumulative of the additional debts. Okay. Now, say that you are paying off or excluding something in that additional debts part, right? You are going to need to manually deduct it from this screen, okay? So where I usually do that is I do other expense, and I'll put a negative of the amount of the monthly that you're excluding or paying off, and you'll put it in this other expense and do a negative so it counteracts it.
Why do you choose to do it that way versus just reducing the other liabilities by the amount?
Because, I mean, you could do it that way too. I just think this is the easiest way to do it because why reduce it? Because it's not going to match the VOL screen. And then you're going to have to explain to the underwriter exactly what you did.
All right, so you think this way it's more efficient with underwriting?
Yes.
Okay, gotcha.
Okay. That pretty much covers this screen. It's very convoluted, so just make sure that you follow the check marks definitely need to be checked. Make sure they're checked for the right liabilities that are added, and then anything else. Okay, the fun part. So this section is about your monthly income and the federal tax deductions. Any deductions from your pay stub for taxes, right? Social Security, Medicare, state, federal, anything additional for any other states that are out there. Okay, so this will auto-populate with all the wage earnings, including self-employment. Okay, so you have to do this on self-employment as well. The way you get the federal tax these deductions is you go to Paycheck City, and I have a link at the bottom. I will show you what it looks like the next page. Okay, you'll need to run it for all borrowers separately, and then you need to make sure you put them in the correct boxes. Now, on this screen, what screws everybody up is that they think they don't look here. It says spouse and borrower. Spouse is the first box, borrower is the second. Make sure you put the appropriate ones in each box.
Okay.
And even underwriters will do it. We all do it because we go, quickly and we're not paying attention. So just make sure that you put them in the appropriate boxes.
Yeah,
Okay?
that's weird.
So box 38, this is where it gets a little fun. Not really, but this is where your other income on your page 2 comes from. Any Social Security, pension, alimony, anything like that. Okay. Now, if you are grossing up any of that income for your DTI to work, you cannot use it in your residual income calculation. Okay. So what you
Like
have
at
to
all,
do,
or you just have to use the original amount?
right? You can't use the gross up amount. Just the
But you
gross
can
up
use
amount.
the original amount.
Right. You can use the
Okay.
actual amount received.
Gotcha.
So basically what you're going to need to do is the fully grossed up amount will be auto-populated, and you'll need to deduct the additional amount from the other deductions. So say like you don't have state in Texas, right? So if you grossed up an amount by $400, you're going to put a negative 400.
Gotcha. So the same
And you're going to
concept.
explain it to the underwriter on the notes section or your cover letter to explain that that's what you did. Okay.
Okay, that makes sense.
All right, this is what Paycheck City looks like. Okay. So the web link works. I made sure. So this is what it will take you to. You're going to, mark the appropriate state. I have Texas in here, right? This check date doesn't matter. It can be today's date. They're not going off of the check date. Okay. You're going to put the gross pay that you have on page 2 in your employment sections. Okay. If you have 2 jobs, you're going to add them together. Okay. So you're going to put that there. You're going to put pay per period in this section for gross pay method. The gross pay year to date can stay 0. And your pay frequency is going to be monthly because it's the monthly income that we use. Oops, sorry, did something weird. Okay, then in this section, if they're married, single, you're going to do the drop down for head of household, married, single, anything like that. The number of allowances, okay? If they are unmarried and have no dependents, you're going to put 1 for themselves. If they're married and themselves, you're going to put 2. However many people are living in the household. So if they have 3 kids and are married and themselves, right? I put 4, but you would put 5 here. I don't know. I'll change that. And then Texas obviously doesn't have any state taxes, but you would do the same thing here. And then hit calculate.
Now that exempt from state tax box, you would mark that, or?
No, you just leave it blank because there's no state tax. Well, depending on what state you're in. Texas
Right, but
doesn't
that
have
says
it.
exempt from state. Oh, so if there was state taxes, but the borrower is exempt from paying them for some
Yeah.
reason?
Right.
Okay,
Yeah.
gotcha.
Okay, here are the results. So it gives you the results and tells you what goes into each bucket. So you can see it all matches to where it goes. And this amount at the bottom of line 37 matches what's on the net pay.
Gotcha. Seems enough.
This is the bottom of section E. Okay, this is going to tell you where your what your residual income is. So what we do is we take line 43 is the final calculation of your residual income, this amount right here. Okay.
Mhm.
They're going to take the sum. Basically, they're going to take your finalized income after your deductions of your taxes, subtracting the debts, which is line 40, and then subtracting the total monthly shelter expense, which is adding that section C that we did with the maintenance, right? And that's your total. Then it's going to give you a residual income. This guideline is from the residual income table, which is on the next slide for you. Okay, so this shows that we passed the residual income test. And we have
How do you know you passed it?
The guideline is less than what your residual income is.
Oh, okay, so as long as the
Okay, so as
guideline
long
is
as
less,
it's below,
then you're good.
and so in essence is a ratio, what we look at, if the ratio is below 100%, would that be another way to
No,
quickly?
this ratio is totally different. This ratio
Okay, so
really,
that they're not related. Okay. So it's
no,
just
the ratio is
guideline
not going
box
to
needs to be
always,
below the other box on the far right. Those two boxes, the one that's highlighted. If the guideline number is less than that, we're good.
right. So your guideline is 441. Your
Yep.
balance is $1,100. So yeah, this one passes. This specific instance.
Oh, okay. Then wait, I'm just gonna reverse it. So the number on the far right that's blue is what's going to populate for our borrower. The guideline is the actual VA guideline. So as long as it's
Yes.
greater than guideline, we're good.
Yep.
Okay. I misunderstood the first time. Okay. So
But also remember that just because you have residual income does not mean you're going to get an approval at 60%.
Yeah, but exactly.
TIA.
But you got to have the residual income correctly to get an accurate AUS finding. You still got to run it
Correct.
through AUS, right? So I think that's the issue we've run into before. Sometimes people leave this box blank. They run their approve eligible. They think they're okay, and then they get burned, right? We've had
It's
that
not,
happen on 2
yeah,
files.
it wouldn't be blank. It would just be over the amount that it actually would be because you didn't do the actual calculation with the maintenance and the deductions and what debts. If you don't click any of the debts, then it's going to say you don't have any debt. So you have to make sure that this is done so that we have the correct amount. Okay, so this ratio most likely will not always, it's not always going to match your DTI amount because everything is kind of different than what we did on our DTI, right? Grossing up income, all those types of things. So this ratio almost will never match your ratio in your file. I think my ratio is 63 and this shows it's 60. So just letting you know, it's not always going to match. Okay. Here's the residual income table for over 80,000. I don't usually do any VA loans under $100,000. So I didn't put that one in here, but it's out there. So here's the key to the geographic areas, right? That go into the table, family size, and then obviously you can see ours was the South with one family size. So we have 441. Okay. And now we have questions. So I know it's a lot of information, but
Where's the PowerPoint saved right now?
in my desktop at the moment.
Okay, cool. All right, so we're gonna get that uploaded. And then can you go back a couple slides? I just wanted to can you clarify for me again on child support? Like there's child support, which is like your traditional child support situation you run into with divorce, right? But we need to make sure we're asking, hey, like for example, we ran into an issue where there was child care, right?
Right.
And so I was just looking at there, like that would need to go in like box number 26, right? Like,
No,
or
it goes in job related expense. So down here you can see it says job related expense.
there we go.
So
That's
there's
okay.
that one
Yeah,
right
I
there.
wanted to just point that out to everybody. Okay, because that's an important question. That's like specifically in the disclosures. That's not a question we want to skip over, right? You got to ask that question, like, hey, do you have child care expenses? So I don't think I saw commuting on there before. That's a good reminder. Okay.
So it's union dues, commuting costs, childcare.
Like, I guess what would be significant commuting costs? Like, that's not
Yeah,
gas.
that's what I was
That would
wondering.
be like maybe
Commuting
like
costs,
trains or flying.
uh,
Like if you like a nurse and you like work in California. Like we had a nurse one time that worked in Dallas, but she flew to a hospital in California 2 times a month. Like if that
I
came
would
up,
say any commuting. So like, I'll give you an example. My husband lived in Sacramento and drove to Oakland every day. Okay, that is a significant commuting cost because that is gas for 100+ miles each way.
got it. So I mean
Right.
that could get you though if like all of a sudden you're like you don't think of it right. You take your 1003, you look at it, and you just say, oh hey, in Sacramento, and like maybe I don't know how far away it is, right?
It's
Like at what point is it significant? Is it 100 miles? Is it 30 miles? Like, is it because gas prices are high right now? Like, what if gas prices go back to $1, a gallon? Like,
yeah, I think most of it, if you work in the matter of like a 30-mile radius, right? It's not a
30 mile.
significant. That's very easy
That's
to
a
say,
general rule
right?
of thumb. Okay.
Well, I don't know
That's
what the
good.
general rule of thumb, but I'm saying, in my opinion, if you're driving to this town over, right? If you're driving to 15 minutes, but it takes you 45 minutes because of where you live, that's not significant. Significant would be if you're driving in a distance. If you're driving from Houston to Dallas every day, that's significant, right? If you're driving
Yeah.
from, just so you know, Oakland is the Bay Area and Sacramento is
Yeah.
an hour from
Okay.
Tahoe.
No, I think
So, yeah,
that's a thing that's burned us before, right? So I just wanted to point that out. Does anybody else have questions for Kayla on this? Raise your hand if you found this helpful.
Yeah, I'm curious.
Found it really helpful.
How would you calc that? I mean, are we literally going to look at gas prices in that area?
No, the borrower puts it on like what his monthly commuting expenses would be. It's on the disclosure.
Oh,
It's on the initial
So
disclosure.
they-
So basically,
so if-
I would think maybe a way to get around that is to put 0 there, right?
Right.
Yeah.
A lot of the times people put 0 there. So,
And it's
but
not
if
going to show
they,
up on a bank statement where you'd get burned on that. Probably like gas is not going to be as like we had it burn us one time was Lori on a bank statement. We didn't know there was childcare. They put 0 on there, but then what happens to look at the bank statement? It's like, holy crap, these people are spending like $600 a month on childcare. Like, and it says like childcare. It was the name of the company. So it's like, oops, and then all of a sudden we put that in there and the loan no longer worked, right? So those are situations where it's like that form on a VA loan, we don't do VA loans very often. That would go, in my opinion, on the deal killer checklist, Lori. So if you want to write that down, is like, do not forget to ask about job-related expenses when you're filling out that initial disclosure. That could completely destroy a deal.
that's a great idea. I will put it on there.
so
Yeah,
like,
It's a hard stop too. You can't disclose the file without actually.
Yeah.
We have to go.
But
and click.
loan officers who don't know what they're doing, they'll just bypass it. Like when I was early in my career, I didn't know what it meant. So I was like, oh, just put 0,
Yeah.
It's like, no. Like you got to ask that question.
Well,
when
it
you're
does
doing the-
specifically say childcare.
Yeah.
Like it'll say, but it doesn't really touch on the other ones. But childcare is like the main
I would
one.
just have processors double check that in your intro call. If you're doing a VA loan, I would say put that on the deal killer checklist for a processor before you submit the loan to underwriting. Just double check. Do you really have no childcare expenses? Especially if the DTI is very tight.
The other thing though, the underwriters will look at as well, just so you're aware, if there's union dues listed on a pay stub and they said 0, right? That's
There's
a big
no
thing.
union dues in Texas. We don't deal with unions here.
Okay, well, I'm
other
just saying in
states, other
general.
states maybe.
If you have kids and both of you are working, well, who's taking care of your kids?
Yeah.
So that's another
100.
thing. They're not just because it's on a bank statement, but if both the parents are working and they have 3 kids out there, independents, right?
I got to go call
So-
Brittany Lee to deliver the news about the credit card. But Kayla, I'm going to go ahead. Let me hit stop recording. I don't think there was any other questions, right?